Well, good morning, friends. It's me, Kenny Polcari. I am the host of the party, and today is Friday, June 16th, 2023. And what is it that we need to know? Well, the ECB raised rates yesterday while the Bank of Japan held their rates at ultra low levels, and that happened overnight. Stocks advanced yesterday. Once again, investors questioning JJ's comments. The dollar weakens, oil takes back the $70 handle, and gold advances back to the trend line at 1975. And what are we having for dinner tonight? We're having the Sicilian, Linguine, and Clams. Okay, mamma mia, when will it stop? Will it stop? What drove the change in tone and risk? I mean, what is happening? CPI and PPI came in better than expected, which is good, but inflation remains solidly in the 5.3% range. There appears to be weakening in the job market. Wages are in decline. Manufacturing PMIs are in contractionary territory. Services PMIs are in expansionary territory. And then on Wednesday, JJ paused, holding rates steady at 5% to 5.25%. But he told us, don't get too comfortable. That 67% of the committee sees higher rates by year end, and those rate cuts that you've all been talking about, yeah, those are not happening. And stocks go higher and higher. Now look, I've told you this. If you're nervous, be strategic. Consider the contra trades. I discussed this yesterday with Charles Payne on Fox Business on making money. You can find the clip in my note. You can find it posted on my Twitter. You can even find it on my LinkedIn if you want to watch the video. But we talked about those contra trades that we've talked about before, and we'll talk about them again. Anyway, yesterday, investors, traders, and algos took stocks higher once again. By 4 p.m., the Dow was up 430 points or 1.2%. The S&P is up 53, 1.2%. The Nasdaq up 156 points, 1.2%. The Russell up 15 points or just 0.8, while the transports outperformed, rising 225 points or 1.6%. The Dow is now snuggling up to and entering a new bear market. It's 20% higher off the October lows, right? It's all very exciting. This is the VIX remains subdued, which again, just might be a contraindicator as it suggests way too much complacency in my mind. The rally that started in the tech space, specifically artificial intelligence, and specifically on March 13th, now appears to be broadening out as investors do two things, right? The first is they're playing catch up, as many asset managers and retail investors were underinvested in tech as they played it safe, right? Moving money into short-term treasuries that were paying 5+%, not knowing exactly what the Fed was going to do with rates. And the second thing is now that tech is up double and triple digits, savvy investors are looking elsewhere. Where else can they allocate new monies into the market to get exposure? I've been saying to look at the underperformers, right? I've been saying that for weeks now. The sectors that have not participated so far because so many people were expecting that sell-off of dynamic proportions, right? Think Mikey Wilson. By now you know that he'd been calling for S&P to trade down to 3,000 before he saw the all-clear sign, and that was when the S&P was at 3,900, which would have represented a 23% pullback if it happened. Now, to be fair, Mike is a well-respected analyst. He's won an award or two, so no one's questioning his pedigree. But in this case, I think, and the market thinks, he missed the boat. But it is what it is. And so last night, that same index busted up and through another century mark, 4,400, before ending the day up 54 points at 44.25. Now, put in perspective. In early March, the S&P was trading at 3850-ish, right? With calls by many of the major investment banks for the market to go lower from there. By the end of March, we had pierced 4,000. 2 weeks later, we kissed and pierced 4,100. By Memorial Day weekend, we breached 4,200. 2 weeks later, on June 9th, it was 4,300. And then only 6 days after that, we busted up and through 4,400. It's amazing, considering that last year, stocks couldn't get out of their own way as investors ran for the door, right, expecting the bottom to fall out. This year, those same investors are all clamoring to get back in the door. It's funny how this happens, right? Even after 42 years, I am still awed by the fact that the herd mentality is alive and well. Now, for those investors that stayed in for the ride, You got your divvies, which you reinvested. You added more money when your stocks were on sale, helping to broaden out your portfolio and take advantage of dollar cost averaging. And now you're sitting back, enjoying the ride. You don't have FOMO, right? The fear of missing out. But you're glad that so many others do. And those short sellers, those short players, yeah, you know, the ones, those hedge funds that made those really big bets of lower prices by June. Yeah, not so much. And when the trade goes against them, they too then become buyers, only adding fuel to the fire. And bam, up and away, which explains the recent surge, which feels a bit stretched to me, but we can discuss that later. We saw gains in everything: industrials, utilities, tech, financials, consumer staples, communications, energy, and healthcare were all up more than 1%. Real estate, basic materials, and consumer discretionary rose by a little bit less, like about 0.7. The value trade, SPYV, was up 1.4%, taking it up 12% year to date. Value. While the growth trade, the SPYG, rose 1.1%, taking it up 20% year to date, right? Think tech growth. We also saw broadening strength further down the scale in sectors that have been unloved this year. Metals and miners up 1.6%. Coal stocks, which were winners last year, have been the leading losers this year. Some names down 20%, while others were holding their own. Found plenty of bids yesterday. BTU up 3.2%. AMR up 5%. Cracker up 5%. Aerospace and defense names up 1%, and the list goes on. Mid-cap value, IJJ, and mid-cap growth, IJT, also up by 0.8%, leaving those two sectors up 6% year to date. They too have been underperforming, and investors have found opportunity there as well. In the end, it's about the plan. Yesterday's eco data continues to provide more insight. Retail sales were stronger than expected. Think a healthy consumer, right? Initial jobless claims and continuing claims were up, suggesting a slightly softening labor market, which the Fed wants to see. Empire manufacturing was not the disaster they expected. The Philly was. Industrial production weaker, while capacity utilization was in line. And what does it all mean for you? It means stay the course. Don't stress. That's what it means. Eco data today is all about the University of Michigan data points. Sentiment expected to be 60, slightly higher than last month. One-year inflation estimates remain solidly in the 4% range, while the 5- and 10-year inflation estimates suggest 3%. I didn't see a 2% anywhere in that report, did you? I wonder what that means. Now, this morning, U.S. futures are churning. In Asia, the BOJ did nothing, holding rates at ultra-low levels. In Europe, the ECB raised rates by 25 basis points as Christine Lagarde, the ECB president, told investors when asked if she was done, she said, "No, we're not done." Now, that's pretty clear, isn't it? But remember, they started raising rates when they were in negative territory and remained 2% below where the Fed is. And history suggests that the ECB needs to fall in line with the Fed, which only means either she needs to raise rates or we need to cut rates. And cutting rates is not an option, according to JJ. So as we said, she said, we are not thinking about pausing. Dow futures this morning slightly weaker, down 11. Dow's down 11, S&P's down 2, the Nasdaq's up 5, the Russell is off by 4. And as expected, the media is already focusing on the next 6 weeks until the next FOMC meeting as they ponder when the cumulative effects of all this tightening is going to have on the economy and on monetary policy, right? Because that's what they're all talking about. There's a lag effect. European markets this morning are all higher after that ECB decision, as investors there and really across the globe feel a little bit better about how the ECB is handling its economy. At 6:30 this morning, most markets across the region were up about 0.5%. France, the outlier, was up 0.8, while Germany was the outlier on the other end, only up a quarter of a percent. Oil, well, it took back the 70 handle again as it's ricocheting around 65 and 75 continues. And why? Oh, right. It's the China demand story all over again. Are you seeing the pattern here? They talk oil down on a China slowdown on Monday, and then they change the story on Wednesday after they've all gotten long, and they ride it right back up. Suddenly, the data shows that China's refineries are working overtime. Output is up 15% as Chinese demand is expected to keep climbing. It's comical. So remember that the next time they tell you that Chinese demand is slowing and they try to sell oil off. In addition, a weaker dollar also helped to push oil higher. This morning, oil is trading at $70.10 a barrel, leaving it $3 away from the short-term trend line, which is resistance at $73.67, which we've tested 3 times already. And so keep your eyes on the 4th time. And while it's not happening today, it most likely will happen next week. But the other 2 trend lines, the intermediate and the long term, are sitting right on top. So let's not kid ourselves, right? It's going to be a struggle for oil to bust up and through $76, unless, of course, the dollar weakens significantly or the Saudis and OPEC start slashing production. Gold also took back the trend line at 1975 as the dollar index weakened a bit, plunging through the trend line at 102.61, leaving it trading at 102.21 this morning, on its way to potentially testing the May lows of 101.50. And if it does, that will benefit the whole commodity complex. This morning, Treasury yields remain essentially unchanged. The 2-year Treasury yielding 4.6%, the 10-year 3.8, The shorter duration bills, 3 and 6 months, are yielding 5.1 and 5.3% respectively. Not a whole lot of movement there. The S&P last night closed at 4425, up 53 points and up through another century mark. This morning, the tone suggests uncertainty. Could we see a pullback? We could. But today's also a big option expiry day, so expect all kinds of volumes and trades as these option players need to roll out or close these positions. But in the end, that means absolutely nothing to the long-term investor, but it does have the ability to cause some short-term disruption in 1 or 2 names, right? Again, nothing for you to be concerned about, unless, of course, you're a day trader trying to take advantage of the volatility. Look, all you have to do is look at the chart. It goes up in a straight line. And that's not going to continue. So get ready for a pullback. And that's not a threat. It's just common sense, right? The S&P is 7% above the short-term trend line, and it's 12% above the long-term trend line. A reversal to the trend line should not be unexpected. I'm just saying. So get ready for what I think should be a pullback. Doesn't mean I'm panicking. Just means get ready. Now, stick to the plan. Build out the defensive part of your portfolio. Do not keep chasing those tech names that are way, way overdone. If you're nervous about the decline, here we go again. Position yourself with some of those contra trades, but remember, they're strategic. They're not long-term holds. Watch the video clip and you'll understand as Charles and I discuss it, right? Okay, so now the weekend is here. It's Friday, and what do we have for dinner tonight? So this is easy, but it's a little bit of a twist on typical linguine and clams. It's Sicilian-style linguine and clams. Now, Sicily is the largest island in the Mediterranean Sea. It's located right off the tip of the boot of Italy, right? And along with some of the smaller islands, makes up an autonomous region of Italy, otherwise known as Regione Autonoma Siciliana. It's rich in history, right? Think Don Corleone, right? It's rich in culture, food, art, music, and architecture. The agriculture sector is a significant part of the economy, producing lemons and oranges, along with olives, grapes, and wine. Additionally, many of the recipes make use of fish. So today we're featuring the classic Sicilian-style linguine and clam sauce. It's a spectacular dish. It's not your usual linguine and clam sauce, so try it, won't you? Because it's really, really good. And for this, you're going to need 2 dozen clams, plus a container of minced clams. You need olive oil. You need chorizo, garlic, shallots, white wine, clam juice, linguine, Parmigiana cheese. Always, you need breadcrumbs and you need butter. Start by bringing a pot of salted water to a rolling boil so it's ready when you need it. Just put it on the back burner. Next, take a half of the chorizo sausage, remove it from the skin, dice it up, add it to a pot, another pot, right? Next, dice up 2 of the shallots, add those to the pot. Third, take 3 cloves of garlic, smash them and then chop them, add those to the pot. Now, take a bit of olive oil, maybe 2 or 3 times around the pot with the olive oil. Turn the heat up to medium and saute all that for 4 to 5 minutes because you don't want to burn the chorizo, but you want it to kind of render a little bit, right? Now add some white wine. Now look, I just poured in, but I'm thinking, maybe it's 2 cups of white wine. Bring it to a boil, let the alcohol burn off. Now add in 1 bottle of the clam juice, but always have a second bottle just in case you need it. and add the clams, the 2 dozen clams, and the container of minced clams. Turn the heat to low and allow the clams to open, remembering to discard any clam that does not open on its own. While this is simmering, in a separate frying pan, add a dollop of butter and then add the Italian seasoned breadcrumbs. Turn up the heat to medium-high and saute the breadcrumbs there in the butter and allow them to get toasty, right? They're going to get nice and crunchy and toasty. Be careful, you don't want to burn them. Then set those aside. You can also do those in the oven if you want, but whatever. Now, add the linguine to the pot of water, cook it till it's al dente, maybe you know it's 8 minutes. Strain, you always want to keep the pasta water there just in case you need it. Return the pasta to, put the pasta right in with the clams, right, in the other pot. Mix it well. Add 2 handfuls of Parmigiana cheese. Mix it again. You want to serve this in warm bowls, adorning each bowl with clams, right? The actual clam with the shell, and the clam sauce and all that stuff. But also take a handful or spoonful of the toasted breadcrumbs and sprinkle it all on top and serve it, right? Have extra cheese on the table for your guests and serve this with, you know what? My favorite chilled white wine, Pinot Grigio Santa Margherita. And it doesn't get any better than that. It really does not get any better than that. And once you try this, it's a little bit of a twist on linguine and clams, but you will also enjoy it. In any event, it's Friday, it's Father's Day weekend, so happy Father's Day to all the fathers out there, and fathers to be. And until Monday, take good care.